Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Last week, we spoke about some tax strategy that's available to use post year end. So, you know that I always talk to you about saving and planning for tax savings before the year ends, because this is where we have a big room for planning. But once the year ends, there is still hope. There are a few things that we can do, and that's what I want to focus on today to talk to you about, so that you have some hope, you have some, you know what to focus on when you prepare your tax return. And if you hear from your tax accountant that you owe that much, maybe you should consider one of those strategies. All right, so let me share my screen with you, and as usual, I like to start with a joke, and the joke today is about the preparation when a client is trying to prepare for the year end and they're looking for the receipts. All right, so post year end tax strategies. What are the moves that you can still make for 2025? There's some valuable tax strategies that are still available in early 2026 for your 2025 tax year, and we'll be talking about the deadlines for these strategies, like retirement contribution up to April 15, 2026, health saving account, HSA funding, self-employed plan establishment and funding, and new OBBA deductions to optimize. What we're talking about. Number one, the IRA contribution. You still can contribute to your IRA account and take a deduction on it. You have up till the deadline of April 15, 2026 to make a 2025 contribution. And you just need to tell them that this is for a prior year contribution so that you're able to take the deduction on your 2025 tax return. The limits are 7K for individuals, 8K if you're age 50 and above, because they give you the option to catch up on prior contributions if you haven't had a chance to do so. And as we said before, is it a Roth or traditional IRA is the one that give you the deduction. So if you're worried about reducing your tax bill, then you should do it as a traditional IRA because it's above the line deduction. So it is a deduction before we talk about your standard, your itemized, or any of that. So it's considered in your adjusted gross income. All right, and there is also a chance to do backdoor Roth IRA conversion. So if you're not eligible to participate or to contribute to a traditional IRA, you can do a Roth IRA conversion from a Roth to traditional. Okay, that's number one. Number two, health saving account, HSA. HSA is same deadline, April 15, 2026 for 2025 contribution. You can contribute up to 4,300 for yourself, or if you have a family plan and you need to be enrolled in a health, like in an insurance that allows HSA contribution, high deductible plan. And if you're participating as an individual, that would be the limit 4,300. If it's a family, then it's 8,550. And you still can do this contribution post year end. So if you're self-employed, this is something that you may need to consider. Like if it's not something that you do with the employer, even if you're doing it with the employer, but you're not doing HSA contribution, or if you didn't max it, this is still an option. And if you're age 55 plus, then you can do another $1,000 catch up. What is the tax advantage of health saving account? Number one, it's deductible. So it gives you deductibility on your tax return. It grows tax free, and when you withdraw it for eligible medical expenses, it's tax free. So you don't pay taxes on the withdrawals. All right, and it's something that you own. You don't lose it. It's not similar to the FSA, the flexible saving account. It's something that you keep until the time you need it for medical expenses. All right, so it's definitely something to consider if you still haven't optimized this option. All right, what else? Self-employed retirement plans. So if you're a medical practice owner, if you have your own business, then you can consider doing a SIP IRA, which you can contribute up to 70K for 2025, or a solo 401K if you're just one employee or one man shop. Then it's you can do the solo 401K, and you can do the employer contribution. You can do it by the extended deadline. So not only April 15 when you file, but or in this case, if it's like SIP IRA or like it's not the business, if you have an S corporation, then it's not by March 15. You can do it by the extended deadline, September 15. So that gives you like almost 9 months to contribute to this plan and take the deduction for it in 2025. And this is a big number. This is 70K. So it depends on your tax bracket that translates into tax dollars into your pocket. So you can establish it and fund it by the extended due date. So even if you haven't established the SIP IRA, you still can do that by year end. I'm sorry, by the extended due date. And it gives you above the line deduction because it's included in your adjusted gross income. And why this is important? Because a lot of the phase out limitations is it depends on how much is your AGI. So that's why when we do planning, we try to maximize the deduction that's above the line. That's separate strategy than if we're doing maximizing the deduction that goes into your itemized deduction. Okay. All right. Of course, as you may know, and we talked about it last year, the O3BA law allowed the SALT deduction, the state and local tax deduction, to increase from 10K to 40K, but the income phases out at 500K modified adjusted gross income. So that's just an example to give you why the adjusted gross income is important, because all these phase outs and all the limitations is based on the AGI. So as much as you do above the line deduction, you may be eligible for more things than what you would usually be eligible for under different circumstances. That's why planning is really, really important, because you may say, oh, I don't want to contribute 70K, but guess what? If you contributed the 70K, you may reduce your AGI to just below the 500K. So you're able to trigger another 30K from 10 to 40 into itemized deductions. So you basically got your half of your 70K back in addition to the savings on the 70K. So you find yourself winning big if you just plan it right based on your numbers. Okay, this number is indexed. So if we're talking about 2026, this number is going to increase to 40,400 and it will keep going up as inflation. And index means it changes with inflation. Same as we like your standard deduction. It changes with the inflation rate, things like that. All right, so something to consider is to optimize the state versus sales tax election on your 2025 returns. So when you take a look at your tax return, you need to make sure you have the best or the highest number to deduct. All right. There's some additional O3BA provisions like the auto loan interest deduction. This was something that wasn't there before. And if you have that, you need to remember to give it to your tax advisor or tax preparer if he didn't ask you for it. So auto loan interest deduction, if it's made in the US and you're paying interest on your auto finance, this is a deduction and it has its own limits. Enhanced senior deduction. Yeah, the Social Security is still taxable, but you get some deduction. You get a 4K deduction. Expanded child tax credit and increased in value. So these are things that are still available for you. And the QBI deduction is retained, something that made a lot of people happy that it did not expire. So this is not really something that you'd have to worry about for like planning or something new, but those are new things that you need to consider. Okay. Business planning opportunities. So as a business, you need to do the accounting methods elections on your 2025 return, whether it's accrual, cash method, there is a planning opportunity there because things could change based on what method you're using. Section 179 versus bonus depreciation. Bonus depreciation is back to 100%. Section 179 allows you to do 100%, but there is a difference between the two of them that we talked about before, and the choice between the two may benefit you based on your situation. Entity structure optimization. So do you need to do an election for an S corp? You still can do that. So these are like 2020, like learning from the past and changing in the future. For some newly informed 2025, you still have till the date of filing your tax return to do the S corp election if this is something that's optimized for you. But if it's not the ideal structure, then maybe not. Again, depends on your situation. You need to coordinate the QBI deduction with the new provisions. So a lot of planning opportunities are there based on your situation. The key deadline summary, April 15, 2026 for your IRA and HSA contribution. The extended due date, so depends on when you actually file, but the ultimate date is September 15 for SEP and business plan funding. When do you file? Make sure you have the O3B elections and deductions made correctly. You need to consider extending to maximize planning flexibility. Like if you want to fund your SEP IRA by September 15 and instead of March 15 because of your cash flow, this is something to consider. All right, so if you have any questions, please feel free to reach out for your specific situation, whether there is something to be done for your specific situation or not really. It all depends on your tax situation. So we'll ask you for tax returns, we'll ask you for numbers, we'll ask you for business information, and we can talk from there. The goal is always to save you on taxes, to use these savings into your wealth building in different ways and investing it in yourself, in your family, and to make the best decision ever. All right, so hopefully you found this helpful, and I'll see you next week.